Started the recording. Okay. So I put the separate sheet for this topic. I'm calling it futures and forwards, and this will also deal with, as you can see here from this sheet, which is here, also deal with OTC and exchange traded markets, that particular topic as well. So let's continue from this is where we were. Right, so we were discussing margins, as we have here in our, we will continue with margin accounts. We were looking at the working of margin accounts. Let's open our calc file. Well, actually we have in this file itself, we have the layout where we have the listing of this particular file. We have the layout of the schema of how things work, and we have all these different players that are involved here. Let's look at this. This is what we were looking at. Reduce the zoom a little bit. Maybe you can see this better. Yeah. So this is what we were looking at, and the flow of margins. We were looking at how the margins work, the margining system, how it works. So let's go back to the place in the book where we were. Page 29. It should be. Yeah, so this is where we were. Okay, this is where we were actually, right? So we discussed these points about troy ounces and all that little details, and actually the point about the it's the daily P&L that is being settled, and not the futures contract itself, which will run till the expiry or until you close it out. Okay. Does anybody have any doubt about the system, how it works? Let's illustrate it once again with respect to this. Yes, Mukul? You raised your hand.
It was some glitch. अपने आप हो गया था सर, पता नहीं चला.
Okay, no problem. Okay. So, so the system, how it works is, as you can see here, the system that is being described here, that when you enter into a contract, what will happen is if you, from the day that you enter into the contract, there will be a settlement price at the end of the day. And based on that entry price and the settlement price, if you lose a certain amount, you can see these losses being shown here, right? So here you have this trade price. You enter into the trade at this price, okay, and you go long, and then the settlement price that day itself. Okay, so you may go long in the morning, and by evening when the trade closes, the settlement price is 41, so you've lost this $9. And two contracts into $9, that's 1,800. Okay, so because the contract is for 100 troy ounces, so this is what you lost. Now this is basically going to be deducted from your margin account. Okay, if there's enough funds here above, if it's above the maintenance margin, it's going to be deducted from there, and then it will be paid out to the guy who wins. So if you see here, so if Vipul has lost money, he's entered into the trade and he's the one who's losing money, and on the other side, Utsav is the one who's making money. What will happen? The flow of funds is going to be like this. In this case, there's no flow of funds because the money is already there in his account. He's already submitted the money. So initially, he would have submitted money through his introducing broker to the clearing member, and from then onwards to the CME clearing account. So this guy is maintaining an account with the clearinghouse, okay, just like a scheduled commercial bank maintains an account with the Reserve Bank of India. This guy's main, and this CME clearing is keeping a track of. So this we're talking about a CME transaction, or it could be any other clearinghouse. Okay, any other clearinghouse that is involved in any exchange traded transaction. So we have just given the example of CME clearing here. Okay, so this is not the general aspect of it. This is a particular exchange. So it could be NSE clearing, or it could be NYSE clearing, or it could be any other exchange. Okay, so you substitute the name of the exchange here. So what will happen is that the money is already gone, and this guy has to. So these guys know how many transactions are open on account of this clearing member, Interactive Brokers, let's say, IB. So these guys are going to demand from these guys that for the number of contracts that you have open, please post initial margin. Here I've given you a link to performance bonds and margins under this, okay, where we go into the discussion of margins. Okay, there's of course a lot of discussion in the textbook itself. You can read about it, but I always want to give you a real life flavor. So this is what margins look like, how margins are being discussed on an exchange webpage, a very, very big exchange group. So you can see here what these are. So you can read a little bit about other margin aspects. But the main thing we want to look at is this idea of here. Okay. So he's already paid. So these guys keep a track of how many transactions came through IB. And each transaction, each contract has an initial margin requirement, as is given in this case as well, right? Each initial margin is 6,000. So these guys are going to make sure that IB, on account of IB, the account that IB is maintaining with CME clearing, that account has the number of contracts into the initial margin per contract. That amount they're going to keep track of. And where are these guys going to get the money? They're not going to put up their own money. They're going to ask their corresponding clearing introducing brokers. All your customer, you had this guy Vipul Garg who opened an account, did a transaction. Please make sure he has enough balance in his account. So this is going to go through them, and so this chain will operate, and then the money will be there. So if Vipul loses money on the first day, that amount is going to be deducted from his account, and it will be paid to the corresponding clearing member here for Utsav, and then Utsav can take out this money. I think we discussed this the other day, right? So this is the point to understand, that you put in money. So the few things you want to understand is, let me see where he has talked about it. Okay, we went in. Yeah. So the point to note, the first thing to note is the initial margin. Okay. And the daily settlement of P&L and the marking to market. These two, M2M, we already understood earlier. Okay, so these are terms we have to understand. Okay, so let me just write down. Let me just make a note of these terms as we are studying them, so that you have a kind of a tracker. We are now trying to understand margins. Operation of margins is a very important aspect of understanding the operation of these markets. Okay, understanding the operation of once you understand how margins operate, you will understand how exactly these exchange clearing houses are able to protect themselves against a large scale default situation. Because the trick essentially is that you are being asked on a daily basis to pay up for your losses, and you are able to collect on your profits. So essentially what happens is things never get too much out of control, because every day, whatever loss you have to pay. If you don't pay up, the next day they're going to close your account. They're going to close your position. So the maximum damage that can happen is basically about 1 or 2 days movement. So that's how they protect themselves. So that's the trick. Make them pay this difference every day. So this is what is happening here. So the point we want to note is IM. Okay. So initial margin. I'm not going to write margin every time. Okay. Initial margin. This is one thing we want to note. And the other track other point that we want to note. So initial margin is what you want to put up every time. So every contract has a particular initial margin. If you can see here, you can watch this video as well. Okay. Initial margin is the upfront payment. Okay. And you can see here, for instance, that the initial margin, the value of the contract is they have not mentioned the value of the contract here. Whatever it is, it's going to be much. It's a very big contract. Okay. So the point is basically, if you do a transaction in this particular energy futures contract, you have to put up initial margin of 1540 if you are a speculative trader. So this point here is the speculative trader would be somebody like this. Okay. So somebody like Whirlpool or any company like a Nestle would be classified as a hedger. So if it's a speculative trader, they're seen as more risky and they have more risk. So they have to put up slightly higher margin. Okay. And hedge customers or members as in clearing members, these guys have to put up less margin. So a little bit less margin. You can see the difference. When the margin per contract for speculative customers is 1540 initial margin, the margin for the hedgers and the members is 1400. Okay. So one of the things we can look at, so when you look at margins, we can talk about three types of margin. Three concepts are important. Initial, maintenance, margin, and the other one that we want to talk about is variation margin. Okay. So, and then this is one aspect, and we can say that IM. Okay. Let's look at the differences here. So this is one idea we want to have, that there are three important concepts when it comes to margin: initial, maintenance, and variation margin. And we also want to look at something else, which is that the IM, if you notice, yeah. So if you notice one thing here, that there is a difference between categories of customers. Okay. This is something else also you should be aware of, because sometimes you might operate. Now, this distinction may not happen in the Indian markets, okay, but it's an important distinction to be aware of. That in most of the global futures markets, especially in the U.S. markets, which are the biggest markets in the world in terms of volume, there is a distinction made between speculative customers and hedging customers and members, because these guys are seen as having less risk, and the members are like in-house guys, so there's less exposure for the exchange. Because remember, because IB is a clearing, anybody is a clearing member, has to maintain a core balance with CME, with the clearinghouse anyway. So the clearinghouse has that additional level of security. So these guys have to put up less initial margin. And also, if you're a hedging customer like Nestle, if you're a Nestle, or if you are some other company like a Tata Exports or someone who is exporting, say, soybean meal, soybean oil, etc. So these are people who deal in the physical product. And so they may actually use futures for hedging, which is essentially the kind of activity you're doing. Be on mute. All right. Okay. So if you have, that's the kind of activity that you're going to be doing in your project. Okay. So hedging activity using futures contracts. Now, hedgers also have less risk, as you will see. If you remember, this is something else you should note in your preparatory studies. There is a note that I have for you called, there's a note called, there's a note called this one, types of players in financial markets. Okay, so why? You'll notice that when we talk about types of players in financial markets, we have all these different types of players. You've already studied this. If you haven't, please make sure you read this note once again. And you'll notice that the definition of hedgers are basically people who reduce their total risk with their first transaction. So classical hedgers should always be looking to reduce their risk. Slowly, stage-wise, they should never increase their risk. They should decrease their total risk. Whereas speculators look to start, they start out by increasing their total risk. So therefore, these guys are seen as less risky because they're always on the lookout to reduce their risk, whereas these guys tend to generally increase their risk to make more money. So that's why you see that exchanges allow, they ask speculative traders to put up little more initial margin than the hedge customers and the clearing members. Okay, so that's another thing we want to keep a note of when we are studying margins. That initial margin differs according to category of customer. So we can write this as spec custody. Okay, so this is what we use for market jargon for customer is spec custody. Spec custody has to put up more IM than hedger and clearing. Okay, this is actually already written. IM here is initial margin. Okay, right. So this is already written over here. Okay, as you can see from the CME page. Okay, so this is what we have here. So this is one thing we have to note is initial margin, maintenance margin, and variation. We'll come to these two. What are these two? As you can see here, this is just a level that these guys, it's like a kind of a trigger level. Okay, so initial margin, maintenance is always lower than the initial margin. You can see the example here in the Canadian crude product. And this is a futures contract. Okay, you can see the difference that let's look at the spec settings. There you can see the difference between the IM and the maintenance. You can see this 1540 and 1400, and these guys are also telling you that there is a formula that they have. Okay, they set the initial margin, the IM is 110% of the maintenance margin. Okay, so the formula that they have. So the point is basically there'll be two of these levels, trigger levels set for each product. Every product that you do will have two of these levels. Okay, so here they're talking about initial margin. Okay, 6,000, and at some point of time, so the first thing is that there is a daily settlement of losses. So this is something else we want to note. We want to make sure we note these things. Okay, so we're talking about initial margin and maintenance margin. We can talk about this earlier itself. In fact, we discussed this. Gains and losses of you can write this as daily M2M, okay, of futures contracts. Okay, so that's one thing to note. Okay, so daily M2M, gains and losses on a futures contract are settled daily, and then you have the initial margin. And if, as you can see here in the example that they have given you here, that the maintenance margin is 4,005 per contract. Okay, so 9,000, the two contracts, 9,000 is the total. So this guy has put up, initially he has put up this much money, okay, 12,000. And every day there are losses happening, so his account is getting debited. Okay, so when he's losing money, his account is getting debited. And so ultimately, when it comes to a point where it falls below 9,000, the maintenance margin level, he gets what is called a margin call. Okay, this gets a margin call, and he has to top up to the initial margin level. He has to go back to the initial margin level. So this is like a kind of a red alert kind of level, a maintenance margin. It has to go back to the initial margin level. Okay, so the point here, this is basically the idea here in margining. It's pretty simple, I think. Once you get the idea, it's easy to understand. Let's see here if there are any other highlights we want to look at. You can read this example. And okay. Yeah, daily settlement marking to market. So you have the losses. Yeah, so there is this idea that obviously this money has to actually be paid, okay? And you can take out the balance, the excess profit that you have, okay? Which is, just move this a little bit. Oh, we can't move it anymore. Yeah. So now here there's a term called variation margin. So variation margin, you'll hear this, you can see this discussed in the Nattenberg book as well. And the Nattenberg auction book also, when he talks about, if you read that book, he talks about the operation of markets. He will also talk about variation margin. So this variation margin is basically the amount that you have to pay, okay, to make up these losses, this call when the margin call goes out. Okay, so the point we have to note is that yeah, so if you don't pay, if the trader doesn't provide the losses that are being asked for by the exchange, the variation margin, the broker will close out the position. Okay, so they'll close out the full amount of the position. There is a point here that is mentioned in the book as well. Okay. Yeah, they've talked about this. Okay. Yeah. Okay. So excess not withdrawn. So the point here is that let's talk about this part. That initially, that the point I wanted to mention here is this: that initial margin is the initial margin can be paid. Okay. Yeah. Okay. So that's what he's talking about here. That when you want to put up initial margin, the you can actually put up like T-bills and stuff like that. There'll be a margin. There'll be a little bit of a haircut. Okay. This is called a haircut, where you have this. So here you have a 10% haircut. So if you put up treasury bills, if you put up T-bills worth of $1 million, and I give you credit for 900,000 for that, that means I'm applying a 10% haircut. So the T-bills are worth $1 million. I'm recording that as only 900,000 because I'm applying a 10% haircut. But this can be done, so you can actually use interest rate bearing instruments to put up a margin, and that's why these brokers. That's why he's saying that they pay balance on the interest in a margin account. This is a matter of negotiation between brokers. It depends on how big your margin account is. IB has a cutoff limit. I think below 100,000, they don't pay market rate. They don't pay interest actually. So they may have changed that figure right now. So that figure keeps changing. It's a matter of negotiation between these parties. Okay. So there's no fixed rule on that point. But the point is that you can pay it in the form of interest-bearing securities. Okay. Okay, so here, is there anything else that we need to discuss? Minimum margin levels are, okay, yeah. So this is another thing that you need to understand in case anybody goes to work, because now we have a lot of exchanges in India. Okay, so what you have to understand is that so this has to be negotiated with the broker. Okay. Now, this is the other. What is the other point I was trying to mention here? Yeah. Okay. Level of IM and MM. Okay. In this context, in this particular module, when we are writing IM and MM, obviously we mean initial margin and maintenance margin. In some other context, MM might have referred to market maker, etc. But you have to understand the context here. So initial margin and maintenance margin levels of IM and MM are they depend on volatility of asset. Okay. Okay. So the point here is that when you look at different margins, that why are they putting up this amount of money? This is based, these numbers, they have been derived from looking at the contract size, and also looking at, if you want to look at some, if you want to have a look at margin requirements, which is, if you look at this, so all exchange traded products will have margins, like your options, which you traded earlier. They will have higher margins. Options will also have margins. Okay, and so there is a model here, futures options margin model. We can click on this and see what it is. But the idea mainly is that whatever be the model, that you have to understand what the idea is, that since the exposure of this particular, they're just trying to cover themselves, okay, through the use of margin by collecting margins. So what these guys are going to look at is whatever the product is that is being traded, how much is it likely to move in a couple of days? And I want to make sure that I have enough money to cover potential losses within that couple of days. So what they're going to do is they're going to do a risk analysis, which is nothing but just doing a volatility analysis of the particular asset, and then they will just apply a tool. First, they'll calculate the standard deviation. There are different ways of doing it. You can read about what they have here. Okay. Yeah, so this is actually a little bit more than 2SD. So they want to make sure that this 99% is, these are all based on this kind of typical these normal distribution limits, 1 sigma, 2 sigma, 3 sigma limits that you have. So this is like almost 3 sigma limits. Okay, so you can read about all this. Okay. And you can see all the different products, what kind of margins they have. You can see the margin rates. and check the margin rate. So the point is basically there are different there are different margin levels for different products, and the whole idea is based on volatility. So products which are more volatile tend to move around more, and so they will have higher margins. So that's basically because these guys are trying to cover themselves for the risk of losses over 2 days. So if there is a big loss and Vipul doesn't pay up, then by the time they close out his position, 2 days might have passed. So how much could the contract have moved in value, and how much could the clearinghouse be at risk? So based on that estimate, they force him to pay the money initial margin, so that if there is a loss on the closeout, they will take it out of the initial margin balance that the trader has been forced to put up. So the other thing to understand, if you're interested in, let's say, working for an exchange, that when the exchange is doing all this risk analysis that they're doing, whatever all these models that they do, the main idea is this. Don't lose sight of the main idea, because sometimes people get very lost in very complicated models. All you're trying to do is basically protect yourself, okay, and make sure that you will basically be doing some kind of if we launch our beloved trading view charts, we'll see here you can also do a vol analysis, right? We'll wait for it to load. And so the main idea is only this, that these guys are trying to cover themselves for the risk, because it will take a couple of days, almost a couple of days, for them to realize that this guy is not going to pay up. He's just going to walk away from his contract. He suffered the losses. His losses are too big, and he doesn't want to pay up. So therefore, the clearinghouse will close out his position. So let's look at this here. All right, okay. So here we can look at so if you're setting margins for crude oil, the WTI futures contract, what will happen is you'll be looking at, you can see they have also set periods for, this will be weekly. And here you can look at, these are the indicators. So here you will have certain indicators here, historical volatility. And if you search for volatility, historical volatility, okay? So this historical volatility is, here you can see, this is the figure, okay, 32.6%. So this is what they're going to look at, that as you can see here, there's a dramatic movement here and the volatility goes up, okay? So these guys are basically going to look at the department in the exchange which sets the margin levels. We'll do a volatility analysis and try to estimate how much this contract is likely to move in a day. And depending on that, they will, in a couple of days, they're going to set the initial margin levels to cover the risk of the exchange. Yes? Somebody had a question? Okay. So they're covering at least a 3 sigma movement. They will use a historical volatility and they'll cover a 3 sigma movement, so that they are very much, they should be in general quite secure. Okay. So, but also remember that this is a competitive business. So if you set your margins too high, then you may not get business, because these traders are going to look at the initial margin levels, because they have to put up that much liquidity. So they're going to look at that. So there's also the element of the competitive pressures in the marketplace. But generally, that's not a very big factor, but theoretically, at least, it should be considered. Okay. So we have this, and so the point we make a note of is levels of IM and MM depend on the volatility of the asset. Let's make sure, we're just trying to make sure as we go through, we're trying to make a note of important points to note in this topic. Okay. If you feel at any point of time that whatever I've written is not clear, please tell me, and then I'll write it more clearly. because here I'm just trying to be lazy and okay. So yeah, here he has also talked about the this you can see here that there's another element that individual brokers may require greater margins than the minimum levels given by the clearinghouse. Okay, so if this in this particular case, if we saw that 1540 was the margin for the Canadian energy futures contract, but a broker might require actually, so these guys might require 1540, okay, from these guys per contract. But these guys might actually require a little bit more from their customers. Again, this is a matter which is also affected by competitive pressures, so they can't ask for too much. Okay, but these guys, they can't go lower than what these guys are asking for, but they can go higher. Okay, so that's another element to be aware of. And maybe we should mention one more thing here, that in this note here, that this thing that we have here, this concept, so here what I'm saying is that let's say IB, okay, IB is not a good example, but IB looks like introducing broker. Let's put it this way. Say HDFC Securities, okay, as an example. HDFC as both a introducing broker, let's call it IB here, and clearing member, let's call it CM here. Okay, these guys as both a and IB and a CM. Okay, so the point I'm trying to illustrate here is that when we think conceptually about exchange traded markets, we should visualize the schema like this, that there is a distinct function of an introducing broker whose job itself is to introduce the customers to the clearing member. That's why they're called introducing brokers. But they don't have the same privileges as the clearing members. Okay, so that's why. So they're introducing brokers, and then you have the clearing members who have their accounts with the CME with the clearing house, and therefore they have special trading privileges, etc. So the point is that sometimes in the case of big brokerage firms, they may be big enough to, like Interactive Brokers or HDFC Securities, they may be big enough to cover both these functions in the same, within the same organization. So they have a clearing member, license or sort of a clearing member status with the clearing house. At the same time, they're so big that they have armies of brokers reaching out to clients. So big brokers like Merrill Lynch, okay, in India, you'll have people like HDFC Securities, etc., who are going to be clearing members, and they'll also be talking directly to customers. The pure form of the clearing member does not talk directly to customers, but goes through the introducing brokers. But eventually, this is a kind of a pure, prototypical diagram, which shows the pure functions of these different types of entities. But in practice, big brokers can actually combine these two functions within the same business entity. So you can't really tell the difference. Okay, you'll be trading with HDFC Securities, and they will be directly dealing with the customer, and at the same time, they're also a clearing member. This is also important to understand, that this is actually a functional prototypical schema which shows the distinct functions being performed, but they can actually be combined in one firm. Okay? This is just like your investment banking and M&A advisory. In the big investment banks, M&A advisory is part of the big investment banks, and that's why people confuse it with investment banking. But actually, M&A advisory is a different function. It's just in the big investment banks, they get combined because the banks are so big. So as both an IB and a CM, okay, clearing member. Okay. This is another point to understand. Okay, what are we talking about here? So I'm going quite quickly through the topics, but if you don't understand, as usual, the caveat is that you must ask me if you don't understand anything. Okay. Anytime you don't understand anything,
Sir?
Yeah.
Sir, if we are using futures to hedge our position, so sir, since in futures there is so much of margin required, so wouldn't that make our cost of hedging higher than options?
No, in options also, if you remember that options can be either exchange traded or OTC. Okay. So if you have OTC options, then OTC, as we discussed, OTC players arrange they manage the credit risk between themselves by setting up credit lines, clean credit lines usually. But even in options, you will have margins. Okay, if you have exchange traded options, all exchange traded products will have margins. So the cost of hedging is not that much actually. Because yes, you're right, there will be a cost of hedging, but if you look at the big products like most of the futures products, the margins are around 5%. Okay, so for instance, the value here, if you see the value here, this is now around say 47.5. Okay, so this crude oil contract is around 47.5. If you see the value, typically is going to be if we have it here, today's date, we note here. Okay, so today's date is 5/1. It is 1/5. So if you see, IM typically is around. Say if you see the contract, say let's take CL. Okay. WTI crude, which is going to be one of your contracts. Okay, the contract value is contract position value actually. Basically, contract value is WTI crude. The market price is, let's say, market price is 47.5. Okay, the price per barrel. And the contract value is basically, you have to understand the contract size is 1,000 barrels. Okay, it's 1,000 barrels per contract. If you go to the contract specs, you'll see this contract is 1,000 barrels per contract. Okay, so the contract value here will be recorded as 1,000 into 47.5. Okay, so this is the value of the contract. So the dollar value of one WTI contract at current prices is going to be around this amount. Okay, this 47,500. Okay, but typically IM on these kind of contracts will be much lower. Actually, if you see, IM is likely to be something like it's going to be typically around 5%. Okay. roughly. You can check it. If you take IM as 5%, so the actual IM will be 0.05 into the contract value. So you'll only be putting up this much, okay? So if you look at it, it's not that much actually. If you look at, I'm just giving this as an example, okay? This is typically around approximately this much. For most of the futures contracts, obviously they differ because of the different volatility of different products. Different contracts have different volatility, but approximately around this level, okay? So you're putting up to hedge a product which has 47, this amount of market value, okay? That means if you bought this amount of crude oil today, you would have to pay up this much. But to control this kind of a position, you are only being asked to put up 2.3K. That's actually a pretty good deal if you see. Because see, if you go along one contract, now you're actually, your P&L profile is going to be exactly like as if you had physically bought the same amount of oil. There's no difference in the P&L calculation, because whether you bought 1,000 barrels at 47.5, or you bought one futures contract, okay, by putting up this amount of money, there's no difference in your P&L profile. Remember those, if you look at those, the CME options book that I shared with you. In the CME options book, the first contract is the long futures and short futures. You see how those straight lines move, and there's no difference, okay? Whether you're actually long the physical contract at 47.5 or you're long through the futures. The P&L profile is the same, okay? But the cash outlay is quite different. If you have to actually buy the crude oil, take delivery of the tanker, pay the oil trader and take delivery of the tanker, then that's this much. But if you just buy a futures contract, it's only this much. So it's actually not that much. But you're right that this is still a cost. The cost of funding this $2,375 should be considered. So Siddharth is correct that there is a cost involved, but I just want to highlight that in comparison to the alternative, which is to buy the actual contract, buy the actual product in the cash markets, so-called cash markets, as in cash markets as contrasted with derivative markets like futures contract, like futures markets. So does that answer your question to some extent, Siddharth?
Yes, sir. Sir, but I was asking, like, we are using futures only for hedging in this case, and sir, also in the case of enterprises holding, there gonna be so much of money market instruments and equities, and the positions are going to be large. So like for hedging, wouldn't company would need to keep a large amount in their margin account only for hedging also? So how does that cost comes into play? How is that taken into consideration?
I'll answer the second part of your question first. That particular cost is what I just explained, right? That there is a cost in the sense that you have to consider the funding of this amount, to this initial margin amount. The funding of this amount, that has to be considered. There is a cost involved in that. Okay, so when I also set your project, when I set the balance sheet, when I define the balance sheet of the company for your project trading, that I define with keeping in mind that we have only $1 million in the account, that the paper trading account given by IB. So I have to set the contract position sizes accordingly, so that we have enough money to cover losses. So you have to also budget for, so typically how corporations do it is that they will put up some money. Yeah, they have to put up some money to cover the hedges, but it's still not that bad a deal actually, because you get to cover the market risk and you're not really putting up that much in terms of percentage of the contract value. And they also have to additionally take care of, they usually have credit lines with banks. The banks will essentially arrange for, they will provide this guarantee that, if you have certain losses, we will give you some more, money to borrow, etc., for against your losses, because remember, every time you lose money, if you go short here and you keep losing money, then and it keeps going up, then essentially you have to keep on posting for money into the clearing account. So that those losses, where are those additional monies are going to come from? Usually they will have some kind of a arrangement with the bank with for a credit line. Okay, so these arrangements are set up as part of the whole hedging program, that you have ensure that you have enough money available to support the margin requirements. But all said and done, futures hedging is still very effective, very efficient, because futures markets are very liquid, and you will see that crude oil futures, West Texas crude oil futures actually trade all around the clock. They trade 24/7, although they're an American product, and they trade with very tight spreads. Bid-offer spreads are very low. So these contracts are very liquid, the major futures contracts, and you can hit them very quickly. So you can cover your market risk very quickly. So they still are quite a popular tool for hedging because of all these advantages, even though they have a cost in terms of initial margin. And so this is basically how it works. And the first part which you said, that futures are used only for hedging, that statement is not strictly true. I don't know what you were, what you were trying to say there.
No, sir. I was asking about my example. Like we are using here only for, if we are using only for hedging, then that amount should be taken into consideration.
Yeah, that would be taken into consideration. But just make sure that nobody has a misconception about this, that there is no need, just like options, you had read somewhere about options being used only for hedging. That's not true. Futures also, they're just an instrument, okay? And so this is basically hedgers, speculators, these are types of players, okay? And all types of players can use all types of instruments in different ways, and options and futures are instruments. So you can use, a speculator can use both instruments, a hedger can also use both instruments. So therefore, whether it's options or futures, this example that I gave is an example of used by hedgers. But actually, we were discussing spec margins. So it could be either speculation. So you can use these instruments for either type of activity. Okay. Is this clear?
Sir. Yes, sir.
Okay. So we'll continue with this. So here he has mentioned a little bit about how different types of transactions and different types of players can end up with lower margin requirements. Okay, and he's also mentioned spread transactions. We will discuss spread transactions later, so I'll come back to that. Okay. Yeah, so they are the same on short futures or long futures. Okay. Okay, so you can read about this stuff later. I want to just make sure that we have, let me see what else I want to cover. Let's try to go quickly through this. And yeah, so here is basically just notes on what I've already discussed with you guys, okay? Clearing member, so these kind of things, these are already mentioned, so I'm not going to spend too much time on that. You can read it on your own, and so you'll get more clarity, okay? So credit risk, now you already understand what credit risk is when this guy somebody owes you money and they're not paying up, okay? So it's not just on a loan. Usually we think about credit risk only on a loan, but this is a different perception of credit risk, which is the credit risk that arises from entering into financial contracts. And you may have a situation where you're sitting on a lot of money, not on a profitable position, and the other guy may not honor the contract. Okay, so for instance, you may have bought, in an OTC contract, you may have bought crude oil at this level at 36, and now crude oil futures are at 48 or 47. So you're making a lot of money. But the guy you bought it from, he's not going to pay. Okay, so he's not going to sell you the contract at 30. He's going to say, well, it was a forward contract and he sold it to you at 36. When the time comes for settlement, he's not going to deliver. Okay, he's just going to walk away from the contract. Okay, if you remember, does anyone remember the name of the case that we did in legal aspects of business in breach of contract in the case of securities? Does anyone remember the name of the case? So, okay. So there was a case called AKS Jamal versus Mullah Dawood, where there was a securities contract, sale of shares. And on the day of the settlement, the shares had moved significantly in the favor of one party, who was the non-breaching party, but the other party did not honor the contract. So it's the same kind of concept. Okay, that's an example of credit risk that arises not from a lending transaction, but from a financial contract. Okay, from entering into a financial market transaction, which is a contract to exchange these financial assets. And when one guy has a obligation which has a very high value in the market, he does not, honor that obligation. So that's an example of. That's also an example of credit risk. Okay. Yeah. So he's talked about here some of these examples of credit risk. So this is another term that you need to learn. The use of the term credit risk with respect to financial market transactions. Okay. So he's talked a little bit about OTC markets. Okay, we'll come to this later, central counterparties, where, okay, so maybe we can just discuss it, we can just flow with the book and talk about this, and then that means we go back to our notes. And if you see that I put 3 notes here in your, so we have discussed this. We have discussed OTC versus exchange traded markets. We have discussed the credit risk management, the differences between OTC and exchange traded markets. And now there's this last note, which is the blurring of the distinctions. That will help us to understand what he's talking about here. When he's talking about OTC markets, okay, that usually they used to deal bilaterally. Now, this central counterparty discussion actually should not have been brought in without explaining how things are merging now. So let's look at this particular note that you have, which is a blurring of the distinctions. So the distinction is, I hope everybody's clear about the distinction. So you can see this visual picture here. In the case of ET markets, you have the clearinghouse that is acting as an intermediary and engaging in what we call credit risk intermediation. These terms are all written in your notes. Please make sure you understand these terms. Okay, and these are all these are all things these are all what we call the jargon of the financial markets. Okay, credit risk intermediation. That's a big word, but credit risk intermediation is nothing but what the clearinghouse is doing here. Okay, or what sometimes people say the exchange is doing, because the exchange is closely associated with the clearinghouse. So sometimes people talk about them as if they're the same.
आपने कंट्रोल जी प्रेस करना है और ग्रुप करने के बाद आपने कीबोर्ड से सिर्फ पी का बटन प्रेस करेंगे ताकि पिक्चर बिल्कुल इस पेज के सेंटर.
Okay. So right now here we have before we come to central counterparty. So please make sure you understand what's going on here. Okay, so this is where you have credit risk intermediation by the exchange clearinghouse, and in the case of OTC markets, you have no such intermediation. And I'm just calling each of these clearing members because they're kind of self-clearing for each other. So all these members, they're all trading with each other, and there is no intermediary that is managing their credit risk. Okay, they're managing it themselves. This is the classical situation of the old, historically, traditionally, how OTC markets have operated. Okay, so now what is happening is, and then of course there's the other important distinction of the standardization of products versus non-standardization of product, which is, we can go back to this sheet here. The differences, the 2 main differences is how counterparty credit risk is managed, and the contract terms, whether they are customized or standardized. And then you have other things like market prices, whether they are transparent and visible. There's a listing requirement and the fixed location, etc. Okay. So this here, so this is, once you understood the differences, now what is happening is a blurring of the distinctions. If we look at this is a note that you have. Okay. Yeah, so credit risk intermediation, as I told you, this is the term that you have to learn. This is a term of art, what we call jargon. I mean, the less charitable term is jargon. So when somebody says something like this, it sounds like a big word, but it just refers to that function that is being performed by the exchange clearinghouse. Okay. So the problem is basically as I've mentioned here, that the same thing that the exchange clearinghouse is doing, okay, requiring both traders to post margin if they lose post margin, and then put up the losses, daily losses, if they lose money. All right, and this same idea of daily mark to market and daily mark to market of daily compensation of losses. This same idea can also be implemented in the OTC markets, and that is what the regulators did. If you see, there was a chart that we had here. Under OTC markets, we had a chart. I want to just open that chart. Well, actually, we don't need to open it because that similar chart is there in here. Okay, a similar kind of idea has been expressed here in Figure 2.2. Okay, here he's shown the traditional method of operation of OTC markets. But what happened was essentially the 2000. You can read more about it in the textbook as well. We don't actually need it. It's the same thing. Since we have opened it, we'll go to the end here. The same concept here, the central part. So this was the traditional method, and this is the new method with the central counterparty in the OTC markets. That's why I've clarified that, which is right as central counterparty in this is an OTC market schema here. Okay, which as you can see, same kind of concept here, showing the traditional method and showing the new method, which is happening for a lot of OTC contracts, but not all of them. Okay, so the distinction has not yet fully materialized, but it is happening for many products where the products are quite standardized. The market participants are being forced by the regulators, even in OTC markets, to deal through a central counterparty, which is essentially functioning like the exchange clearinghouse, but it's happening in the OTC markets, not as part of an exchange. Normally, clearinghouses historically have been associated with exchange-traded markets, but here you're talking about an OTC clearinghouse, which we are referring to as a CCP, okay, central counterparty. This is another term that has come up. Okay, so this is the idea here. So the main point was this, that what was happening is that in the if you see or notice here, if you see your readings, I have asked you to read about in chapter 8, where this covers the GFC, the global financial crisis. So I've asked you to read this. I'm not going to cover it separately. At least we don't have time at this point. But here, if you read this, you'll understand that the global financial crisis was associated with a lot of losses in OTC markets on many of these OTC derivative products that these companies had with each other. Many of these companies had very large derivative, OTC derivative transactions between each other, with each other. And when Lehman Brothers collapsed and with some of the other companies had problems, there was a risk of, a kind of a domino effect of defaults. And people lost a lot of money because the derivative products dropped in value. So everybody lost money and everybody had exposures to each other. So that created a big problem in terms of a fear of systemic risk. So therefore, what happened was that the regulatory response is basically this. So basically, regulators, what they were saying is, the idea is like this, that if we had the earlier traditional method of functioning of OTC markets, which were like this, each party dealing with each other, and so if there's a sudden market crisis like the financial global credit crisis, where many derivative products dropped very sharply in value, and many of these guys had position in those products, and so they all had large losses to which they were each exposed, and so therefore this created a lot of fear and panic in the market, and many markets froze up. So the regulators don't want to see that, so they want to make sure now that these transactions, if they're standardized OTC derivatives, then they go through a CCP kind of setup, so that whatever losses people have, they're going to be covered or recovered on a daily basis. So you don't end up with a situation where the losses build up over time, and you have suddenly somebody defaults, and you find that you're owed a huge amount of money. But if you are owed whatever you're owed on a daily basis, if you collect it through the CCP, then you can't have the situation of large losses that you're suddenly faced with. So this is the idea. So what is happening is, that's why I've called this particular note, I've called as a blurring of the distinctions between OTC and exchange traded markets. Okay, this point should have been made. Actually, in this case, he has just gone straight into discussion of central counterparties. But actually, these things are not, these are a fairly new development in the OTC markets. And the traditional way of functioning of OTC markets is actually like what we have shown you here. It has been still largely very much like this, but for standardized products, regulators are insisting on these being done, routed through a central counterparty. That's basically the idea in this note, to make you understand. And this has really been driven by the losses that happened during the GFC, and so the regulators don't want to see that again, and that's why they're doing this and pushing for this standardized clearing through a CCP for standardized products. Okay. The other point I wanted to mention here is that so there is a blurring of the distinction between OTC and ET on 2 points. On one point is credit risk intermediation, which is what has happened here, the regulatory response. But even before this GFC happened, there was some kind of, some banks were taking some measures to control their credit risk. So they were engaging in what was called bilateral collateralization. Okay, collateralization is nothing but this, basically. When you take performance margins, okay, these are called performance bonds or margins. When you take this kind of a margin, all you're doing is you're sort of engaging in collateralization, because you know that as a clearinghouse, you're doing a deal with one customer on this side and another customer on this side. So you're exposed to risks on both sides, and you want them to collateralize, you want these traders to collateralize their exposure to you, or effectively, your exposure to them. It's like you're lending them money. Okay, so collateralization comes from the practice of lending money. Okay, so if you see here, collateralization. So this comes from the word collateral. Okay, and collateral is basically the security that you have to put up for a loan. When you take a mortgage, you put up the value of the house. The house is your collateral, and so that's the security for the loan. So essentially what these guys are saying is, I'm trading with you, so I'm exposed to the risk that your trade might lose money and you may not pay up. So that would be like me lending you money, so I want you to collateralize it. So performance bonds and margins are actually a way of collateralizing this exposure, the credit risk exposure that arises from engaging in financial contracting in financial markets, okay, or entering into financial market transactions. So many players were actually already doing this bilateral collateralization. Bilateral means between two parties, okay. So this stuff that we are talking about here, even before this regulatory response came to push people towards this, okay, even before that, many players were actually already doing this. So like Party A and Party C would have a bilateral collateralization agreement where they would do OTC transactions, but they would have a deal where like every week they will settle the transaction. So you have some flexibility. You can decide it between parties how often you want to settle. So every week they would look at who owes who how much money on the outstanding contracts, and then whatever amount is owed, they would pay up to each other, and essentially they'll be able to trade more with each other because they'll have more exposure limits available. So this is basically how bilateral collateralization would work, and they were already doing a little bit of that between themselves. And there was also this phenomenon of CME Clearport, okay. So CME Clearport was one example where, which is basically, I don't think it's actually accurate to say that this thing which I've written, the initiative along these lines, is not. I think I'm going to rewrite this. Okay. Yes, sure. Yeah.
I think
Okay. So CME Clearport is also an initiative that similarly help to blur the distinction. That's a better way of putting it, because CME Clearport is actually came from a different kind of idea that essentially you can do bilateral collateralization directly between yourselves, but and CME Clearport was also an initiative that you can read more about it in the links. But essentially, this is where CME was saying, the CME clearinghouse was trying to reach out to OTC market participants and saying that, okay, why don't you do your OTC transactions and then pass the settlement of the transactions to us through the Clearport facility, and then we will collect margins from each party, okay, on a regular basis, and therefore your credit risk on that transaction would be reduced. Okay, so Clearport is basically an initiative which helps to keep this one. So under Clearport, you do a trade done OTC and submit it to CME clearing. Okay, so you have basically, when you do a trade OTC, okay, you get the advantage of this. So try to see what is happening in terms of your in an initiative like Clearport, okay, what is happening is you do a trade on the OTC markets and then you submit it to CME clearing for clearing under the CME system. So you get the advantage of both worlds. You get the best of both worlds. So you do a trade OTC, so you get the advantage of high flexibility on contract terms, and then submit it to CME clearing. Okay, then basically here what you have is this. Right? right? So this is basically the idea. This is CME Clearport. This is an initiative. These guys don't want us to write counterparty like this, okay? So this is the advantage here. So first you do the trade OTC and you transfer submit, so you get the benefit of both the worlds, high flexibility and lower credit risk. So this is also an initiative that was going on. So these are some things you need to be aware of, okay? The idea of bilateral collateralization that was already happening between parties, okay, in the OTC markets before the financial crisis. And then there was also initiatives like Clearport, which were trying to take advantage of both the different types of markets, try to get the best of both worlds. And this was essentially an initiative by these guys trying to lure more customers. These guys here are dealing only with ET customers. And they were actually trying to get more customers from the OTC markets to connect with them and use their services. So they came up with this idea of CME Clearport. So this is a business, kind of a business strategy phenomenon, okay? So some of these things have happened, but after the GFC, the regulators are now forcing you to go and do this for all standardized contracts. So this is the background that I wanted to give you, okay? Right, and there's also another element of, in this note, you can see another point on which there is a little bit of blurring happening, which is the contract standardization versus customization, okay? Here what is happening is the exchanges are trying to offer more flexibility. Generally, exchange contracts are very standardized, okay? So they're trying to offer, there's something called flex options. You can read flex interest rates, flex options in equities, okay? So you'll find, so essentially what the exchanges are trying to do is they are trying to bring some element of flexibility into their contract terms in order to compete with So some of you are joining, just make sure that when you rejoin, you're on mute so that we don't have any noise. All right. Okay. So the other point I wanted to mention is that there is also a blurring of distinctions happening on the point of the contract standardization or cost customization, where exchanges are trying to offer some flexibility. You can read about these products and get a feel for it, because normally exchange products have very highly standardized terms, no flexibility at all, but they're trying to offer some flexibility to draw the OTC players, okay? Because remember, OTC players are used to highly customized contracts. So to attract some of the OTC players, they are coming out with new initiatives like flex options. Flex options is example of you have some flexibility in setting your option contracts, okay, the terms of your option contract. So you can read about this, and also interest rate contracts. Okay, so but the point here is, I think we can leave this out. Okay, we can leave this topic out. It's a little bit more complicated, and I don't want to. I'll come back. Leave for later. IFM 20. Okay, I'm not covering this because this is actually a more complicated topic. I don't want to waste time on it right now because we have many things to cover. So let me go through, because we need to start our project as well. So I'll cover this. You can read about it, but I'll cover it myself later on once we have got the project underway. So here, once you understand this discussion that we just had, okay, it may be a little bit theoretical, but it's important to understand what's going on in terms of the theory. So don't switch off when you have theoretical discussions, because you need to make sure you understand everything that I'm discussing. So you need to be attentive, and if you don't understand something, you have to ask me. So now that you understand what we discussed, you can now understand this discussion. They're talking about central. You can read the book yourself, and as well as my notes, and understand this for yourself. Okay, so central counterparties, okay, bilateral clearing, all these things we have discussed. Okay. So this is the ISDA master agreement that they use to cover the OTC trades. So this again tells you that financial transactions in financial markets are basically contracts. So you have the credit support annex, the bilateral. Okay, now you can read about this, the long-term capital management. You should know these stories. Okay, that's why I wanted you to read Chapter 8 to understand the story of the global financial crisis. And you should also understand this story from LTCM. Okay, what happened in the case of LTCM. This is another example of this convergence arbitrage is a wrong use of the word arbitrage. Okay, this convergence arbitrage is a wrong use of it, because this is not CRA. What these guys were doing is not CRA. Again, this is another example where the market uses the word arbitrage without thinking rigorously about it, and they use it to describe transactions which are not CRA. So what they were doing actually had not removed the market risk, and they were taking some market risk, and they ended up losing a lot of money because things moved. Like everything else, basically all these models are built based on the assumption that the future will be like the past, but in very important ways, sometimes the future behaves in a very dramatically different fashion, and then everything blows up. So the system is not stable, actually. The financial markets are not stable systems, so that's why modeling is very difficult. It's very difficult to achieve success with predictive modeling. So this particular hedge fund, they had two Nobel laureates actually, Myron Scholes, and I think I remember. So out of the Black-Scholes model, Myron Scholes was on the board of this, or was associated with this fund, and I think Robert Merton was also associated. Another Nobel Prize-winning economists, but two Nobel Prize-winning economists, and the fund still went belly up. They went bankrupt. Basically, they had to be rescued by the Federal Reserve, arranging a bank syndicate had to come up and basically buy their positions and rescue the fund. So you can read about how bilateral collateralization works. Okay, but it's the same concept. There's no complication here. The main idea is every day's losses have to be paid up every day. I mean, pretty much by the next day. So therefore, there's no risk of large losses building up over several days, because you're forcing people to pay their daily losses. And so if anybody is going to create trouble, they will be gone within 2 days. So the maximum loss exposure is for 2 days. So that's the basic idea. So once you understand that, all this stuff you can understand quite easily. You can read all this yourself. Okay, I'm not going to go into that. I want to just finish this chapter. Yeah, so as I said here earlier, that the variation margin does not earn interest, okay, when you have losses. Yeah, if this part you can earn, but on variation margin you will not earn this interest, because variation margin is supposed to be for the losses that you have experienced, which means the other guy can take it out. The other guy, when he has losses and pays the losses here, or it's being taken out of his credit account, of his initial margin balance, they are being paid to the other guy here, so that this guy can actually take out the profits that he has in his account. So that's why you don't get any interest on the money that is used to cover your day-to-day losses. But otherwise, you earn money on your initial margin balance. Okay, so that's what they've talked about here. And they've also mentioned the haircut. There's another term that you need to know, haircut, which is basically the difference between the value of the asset that you have put up as collateral and the value of the loan that you are given. Okay, that difference is known as a haircut. And then you have, okay, these you can read out. These are not very important. I mean, these are, I wouldn't say these are not important. These are important, but these are very simple stuff. You can read this yourself, okay? Settlement price. Make sure you understand. Don't underestimate anything. You should read all this stuff. You can read out the concept of open interest. You can read about it. I'll explain it later, okay? There is a term here which they have used. I want to make sure that these are tables actually. This term is, so we'll come to delivery also, and I've given up to 2.7 in your notes, right? Let me see what I have asked you to read. At 2.1 to 2.7, so we'll cover delivery also. Now, there's a point, let's look at contract specs. Let's look at crude oil. So the part that he's referring to, inverted market and normal market. Let's look at this. We can look at this also. These are, what is the first term? What is the first column? Open, high, low, close. Okay, last trade. Let's look at the last trade, which is the third last column. Okay. You notice here, this is a normal market they're referred to. He's used two terms, okay? Okay, normal settlement prices are increasing function of maturity of the contract. So, okay, so you can see here, he's referred to corn and wheat. You can see it in gold also. Let's just look at corn. Third last, 78, 79, 85, 93, 98, 403. As you go further out on the maturity structure, the prices are increasing. This is, he's called a normal market. Okay, but let's also understand, let's also use a couple of the same thing you can see here, quotes. If you go to quotes, you can see the same thing here, but let's refer to this here by a different term. Add certain different terms here before we come to delivery. Page 35. No, what is the page here? Okay, so we'll continue with this topic and then we'll move on quickly to the case study that we have. Okay, so your class is dismissed and you can leave, and those who have anybody who has a conceptual question should ask it first, and then if somebody has an administrative question, we can deal with that later. Gaurav, your problem of notes access is solved now?
Yes, sir.
Yeah, okay. Yeah, okay. It's basically because I had moved it out. Because for CP and all, I try to move it out. I'll have to figure out a smoother way of doing that. Okay. So does anybody have a conceptual question at this stage? I'll just write it here that we have not yet talked about. Normal versus inverted markets. And I'll just talk about the page number here. Okay, so nobody has a question. I'll just make a note of this. Patterns of futures, I want to make sure that we have the page number, right? That is page number is 36, okay? Page number 36. And so we will talk about, and we were just over here actually. So we'll end today just over here at 1:05. We're ending here just before this. Okay. So if nobody has a question, then I will end the class.
Thank you, sir.
Okay, welcome.